and vulnerable to pullbacks, those pullbacks are a possible buying opportunity. Joining me now is Larry Adam, the Chief Investment Officer over at Raymond James Financial. Larry, the interesting part about this question and segment here is juxtaposing it against what's happening in Washington, D.C., as we've done here. How exactly are the markets dealing with what's happening in Washington and still hovering at or near record highs?
So taking both of those, the first one, when you look at what's happening with the Supreme Court, I don't really think that has a big ramifications on our outlook, because if those tariffs are upheld, it's pretty much status quo. And if they are overturned, I think the president has a plan B where he's going to just reconstitute and get those tariffs ultimately in place, whether he uses 122, 338s, 232s, whatever. But you are going to see his policy of wanting tariffs in place once again by the end of the year or whenever that does need to get put into effect. As far as the shutdown, though, I do think that the longer that does stay in place, it does potentially lead to more downside risk to the economy. Right now, our expectations are prior to this shutdown is that this economy was weakening during this quarter that we're in, pretty close to a 0 to 0.5% growth this quarter. So the longer it stays around, it could potentially make it even weaker.
If you're seeing signs, Larry, of a weakening economy, just how much could markets pull back hypothetically in a scenario where there is a slowdown, perhaps even a possible recession at play? It seems as though every time there is a pullback, it gets bid up, bought up, right? And the pullbacks have become shallower, it seems, over the course of the last few years.
I mean, you're absolutely correct. If you look since those April lows, the biggest drawdown that we've seen in the equity market has been just under 3%. Right? That's 105 days of not having a pullback of more than 3%. That's the second longest streak that we've seen going back to 2000. So that just tells you how small these pullbacks have been. Now, if we do get a pullback, I think it's going to be rather normal. I think somewhere in the neighborhood of 5 to 10% is probably likely. Why? Number one, if you look at technicals, we're 12% above the 200-day moving average. So bringing that back 5 to 10% just gets you still on that upward trend. And then the other thing is that I'm watching for is what could potentially take us lower. And right now, I just think that some of this softness isn't being priced into the market, and it could start to negatively impact earnings, particularly for goods-producing companies. And that could lead to some weaker spending during the holiday shopping season. And, we do a proprietary survey every quarter, and 88% of the respondents in our survey said that they were going to spend the same or less during this upcoming holiday shopping season. So I would look for some potential weakness in those consumer-related names particularly.
Larry, the current price action aside in today's market, what we have seen very near term is more of a relative pullback in some of the Mag 7 tech, media, and telecom mega cap names compared to other parts of the market. Is this perhaps the sign right now that there is vulnerability? And if so, with the economy seemingly there possibly slowing down, is it the time now for investors to start rotating into some of those value-oriented sectors, the more defensive ones in nature?
So I don't think it's a surprise that you're seeing a bigger sell-off in some of those names, right? That's where we've had the biggest upside since those April lows. And if you think about it, those names have a little bit more beta. So if there is a downward tilt to the market, they're going to be more negatively impacted. But going forward, I still believe that the best fundamentals are in those mega cap tech names. I mean, if you just look at this current quarter for earnings that we've seen, you've seen earnings for those companies basically double, 17% versus 8% for the rest of the market. Going in the fourth quarter, that's not expected to change. Actually, you're going to see a tripling where those mega cap tech stocks are expected to see their earnings grow 19%. The rest of the market, only 3%. So I still think that this rotation is going to continue to be delayed until we see a more sustainable increase in earnings for the rest of the market.